India, to the entire India, and in fact, to the entire globe, if possible, yeah. So let me just say that the conference thought, the theme which we have today, financial stability amid global spillovers, is a very, very significantly thought out theme, because if our ambition is to grow fast, I think stability is the most important contributor to it. So there are, it's basically a flat word now, so spillovers occur very fast, and we would, in this conference, debate and go deep into the issue of spillovers, especially as the nature of finance is changing, and we are seeing the digital spread coming into the finance. But the nature of spillovers will change, but the spillovers can become faster also. So that's what we really is all about. I'll request Mr. Ashish Chauhan to come to the floor and give his welcome remarks.
Respected Shri V. Nageswaran, respected Shri Dinesh Khara ji, Professor Mridul Saggar, I am Kozhikode faculty members, esteemed speakers, ladies and gentlemen, it's an honor. I welcome each and every one of you to NSE for the IIM Kozhikode's inaugural annual conference on macroeconomics, banking and finance, securing financial sustainability amid global spillovers. At the outset, I would like to congratulate IIM Kozhikode on behalf of NSE for putting together an excellent program that reflects the dynamic nature of contemporary finance discourse. Secondly, I would also congratulate them for the inauguration of Uruppika, the Center for Excellence in Macroeconomics, Banking and Finance. We are truly privileged to host the unveiling ceremony of the center at NSE that will take place later in the evening today. I sincerely wish from the bottom of my heart that the center goes on to become a beacon of excellence and contributes immensely to the advancement of knowledge and practice in the realms of banking and finance. Today, India stands as the 5th largest economy globally, with annual output of around 3.5 trillion US dollars, or probably 3.8 trillion US dollars, based on which numbers we are talking about, because the GDP numbers are what I call slow frequency numbers, or extreme slow frequency compared to what we deal with every microseconds. Incidentally, India is now the 4th largest capital markets in the world after US, China, and Japan, with a market capitalization of 4.6 trillion US dollars. That's 3.8 crore, that is 14 zeros after 3.84. And comparatively, scheduled commercial banks have a credit outstanding of 160 crore, 1.6 crore, which is almost less than half of India's market capitalization. So effectively, the markets have taken over the wealth creation, but it is also, there is a second side to the coin I'm sure we will discuss today. The banking sector and capital markets have been the pillars of India's growth story, playing a crucial role in keeping the domestic economy largely unaffected by the extant global environment of rising rates and high level of debt. Last 3 years, the number of investors in India has gone up from 2.5 crore, that is 25 million, to now around 8.75 crore, or 87.5 million. By most logic, by most numbers, because we have unique PAN numbers, 8.75 crore investors, they are almost competing with the number of farmers in India. That is, again, it's one of the largest cohorts of any type in India. So these are some of the newer parameters, newer things that are happening in India, and I'm sure some of us would touch upon today those issues on today's discussion. As India marches towards becoming the 3rd largest economy in the world in near future, it can count on 2 sectors to provide sustainable, inclusive, and long-term growth. The agenda for today's conference is rich and diverse, delving into pertinent themes that shape the very foundation of our financial systems. We shall engage in panel discussions and lectures that promise to be intellectually stimulating and insightful. From the efficacy of global financial regulatory reforms to the transformative potential of digital finance, each topic in today's program encapsulates critical and topical issues that demand our attention and expertise. We are privileged to have amongst us highly esteemed and knowledgeable speakers who will help us understand and navigate the intricate landscapes of global finance. The deliberations will revolve around critical questions such as the effectiveness of regulatory reforms in fortifying our financial systems against spillovers, the role of sound regulations in mitigating cross-border ramifications of digital finance, and the strategies for managing spillovers in emerging market economies. We'll also look into the macroeconomic and financial market implications of India's inclusion in the bond index, a development of profound significance in our nation's economic trajectory. We'll close with an interesting fireside chat on the evolving landscape of digital finance, exploring its potential to reshape our financial system. Lastly, I extend my heartfelt gratitude to the organizers, participants, and collaborators for their invaluable contributions in making this conference a reality. Once again, I welcome all of you to this conference and thank you very much for participation. May our deliberations be fruitful, our interactions enriching, and our aspirations transformative. Thank you very much.
Thank you, sir. We would now have the lamp lighting ceremony by our esteemed guest. I am honored to invite Dr. V. Anantha Nageswaran, Chief Economic Advisor to Government of India, Mr. Dinesh Khara, Chairman of SBI, Mr. Ashish Chauhan, and Dr. Mridul Saggar and Dr. Tithankar Patnaik for the lamp lighting ceremony. May I request everybody to be seated on the stage? Thank you. May I request Mr. Dinesh Khara to speak a few words on this occasion?
Thank you very much. Very good morning to all of you. My special thanks to Professor Saggar, head of Center of Macroeconomic Banking and Finance. I am Kozhikode, for inviting me and sharing and giving me an opportunity to share my thoughts on a very important subject. The global economy today is facing multiple challenges. The prospects of slowing growth, large public debt, increasing economic fragmentation, and prolonged geo-economic conflicts. Financial market sentiments have been fluctuating, with changing views about an early pivot by central banks in advanced economies. The likelihood of interest rate cuts has spurred the rallies in equity markets. Although uncertainty about the timing of interest rate reduction is reflected in the bidirectional movement in the US dollar and sovereign bond yields. Likewise, in the emerging market economies also, there are some challenges relating to the currency fluctuations. Amidst the volatile capital flows. Among all these uncertainties, the Indian economy and the domestic financial system has demonstrated a significant resilience, which is essentially supported by the strong macroeconomic fundamentals, healthy balance sheet of the financial institutions, moderating inflation and improving external sector position, and continuing fiscal consolidation as outlined in the budget. Domestic economic activity is strengthening. As per the first advanced estimates released by the NSO, the GDP is expected to grow at 7.3% on a year-on-year basis in 23-24, which actually reflects a strong investment activity on ground. The CRAR and the CET1 ratios of the commercial banks stands at a very strong levels of 16.8 and 13.7% respectively as on September 23. The GNPA ratio and the NNPA ratio of the system is also quite low, which is a reflection of a very sound economic system as of now, banking system as far as the country is concerned. When the world is in the grip of uncertainty, the Indian domestic situation exhibits a positive growth outlook and a robust banking system. The policy initiatives have been able to absorb external shocks quite well, and accordingly corporates and households, and therefore as an extension the financial balance sheets have proved to be quite resilient. So on the face of it, everything looks perfectly fine. And the subject matter of the today's discussion are the new challenges to the banking stability. I'll begin by saying that the banking system is currently stable, and the last 2 financial years have been quite healthy for the banking system in the country. Evolving environment still poses some challenges which the system needs to navigate well in the days to come. Recent developments in the banking system in some advanced economies drive home the importance of ensuring the prudent asset liability management and the robust risk management, and also ensuring the sustainable growth in the liabilities and assets. Undertaking the periodical stress test and building up the capital buffers probably holds the key for ensuring the system remains resilient in the days to come. Early identification and remediation of the risk factors by identifying the root cause of the vulnerabilities and triggering timely intervention before such factors culminate into distress is becoming increasingly important. To my mind, there are going to be 4 tectonic shifts which will shape the future of the financial sector. Let me talk about those 4 factors which will probably prove to be the tectonic shifts. First and foremost is the changes in the domestic and the global economy induced by technology, climate action, geopolitics, and new business model. The domestic and the global economy are undergoing deep structural transformation. Some of the systems of this phenomena include the relocation of the supply chain, demographic aging in the advanced economies such as Europe, US, China, and Japan, and COVID-19 impacted the future longevity in the higher age bracket, and also the premature loss of lives in higher age bracket. This has eventually reflected in the erosion of demand in many of these economies. Many economies across the globe are saddled with high level of public debt and rising dollar interest rates. To control the runaway inflation after Russia-Ukraine conflict is actually putting many of the sovereign countries under various challenges. With global growth projected to slow down further in 2024, the debt servicing might prove to be a further challenge. Additionally, the global multilateralism is giving way to the bilateral arrangement. We are not sure where and how the new equilibrium will be achieved. In the banking system, the structural transformation include growing regulatory oversight to accommodate new business conditions. Basel III and IFRS are getting more stringent. Digitization of the banking services is creating new hyper-customized channel of services, and are also exposing the system to some of the cyber risk also. The prevalence of the legacy technology, such as mainframe-based platform that supports a bank's backup operations, also is one of the area which needs to be addressed. And perhaps the legacy systems needs to be replaced at a faster pace. Nevertheless, even as the banks are updating their legacy systems, the shortage of skills that are required to operate and maintain these core systems may act as a constraint. The NIMs which we are seeing today, there could be a challenge depending upon the ability of the system to raise the liabilities at the kind of price which they have been successful in raising, particularly during the COVID period, when actually the system saw a significantly higher CASA ratios. Let me now talk about the climate action. Climate changes and the mitigation is now on the top priority of India and abroad. With banks expected to contribute towards the transition to net zero, there will be a pressure for adoption of the green technology across the economy. Climate stress test conducted for India by RBI in this report suggests that banks are more prone to the climate risk because they are serving a larger economy, and when the larger economy has to navigate the climate changes, then perhaps it will have an impact on the banking system too. But fortunately, this realization has come in good time, and there is a concerted effort on the part of the system and also on the part of the economy to navigate this particular challenge well. SEBI has also mandated the listed companies that they are required to report in Scope 3 emission going forward. This is being made mandatory by 2025. Scope 3 emissions accounting is still at an initial stage in banks, and to my mind, because the way we are moving towards the climate finance Scope 1, 2, 3, there is a need for a very elaborate accounting mechanism, almost parallel to the accounting system which we have in the financial sector. So on the similar lines as the accounting system is there, perhaps the green accounting is also one of the necessity. Geopolitics has emerged as key factor that may impact all businesses, including banks. There is an ongoing war between Russia and Ukraine, Israel and Hamas. The risk across the Red Sea have significantly increased. These risks have implications for normal economic activity. As of now, it may not be directly impacting us as in India, but the way the global trade happens, the way it starts impacting the psychology, that is something which we cannot ignore. Geopolitical tensions could lead to financial instability through two key channels. The first is directly through a financial channel triggered by the restriction placed on capital flows and payments, or indirectly through an increase in uncertainty and the investors' risk aversion to the future restrictions as there is an escalation of conflict. Rising geopolitical risk also entails that defense spending may go up in the next 5 years. The risk of high-intensity conflict in the next 5 years cannot be ruled out. This will have an obvious implication for the development. Lastly, the emergence of the new business model has altered the risk profile of the businesses. The inherent credit risk in new age startup is very different from the traditional SME. Since forecasting technology is more difficult than forecasting macro aggregates, infusing technology and business change risk profile in a way that is not fully understood is equally important to really appreciate. When we talk about the information availability, there is a whole lot of differences in the availability of information and also the formal structure of the information availability. That is something which we need to address. That is why we see vast divergence between the market valuation and post-listing valuation of startups. In case of platforms, one is not sure how the two-sided markets will behave and what are the inherent risks in the platform. In conclusion, while we are in a phase of high growth trajectory, the evolving situation warrants constant vigilance. The structural changes in the economy creates both opportunities and the vulnerabilities. Shift in technology create both sunrise and sunset sectors, and as banks, we have to ensure that the diversification process of exposure is not lost. As climate mitigation takes the center stage, banks will be at the forefront to mobilize large capital for migration to net zero, green bond mobilization, and green deposit will form a part of the bank's liability. This creates both risk and opportunities. Lastly, geopolitics is changing the growth and inflation dynamics. Given that geopolitics is not easily quantifiable, assessing the impact is a challenge. But it has to be done to ensure that banks are ring-fenced from the adverse impact of the geopolitical events in far-off places. Thank you very much for giving me an opportunity. Thank you.
Thank you, sir. Our next talk is by Dr. V. Ananth Nageswaran. His talk is on macro-financial stability and spillovers in an integrated world. Sir.
This laptop, is it possible? Like, can you put this low?
Yeah. You want to connect it?
No, I want to connect it to, no
Okay.
PowerPoint.
Okay.
Just close it like that, and then I'll keep it on top of
Yeah.
it. Thank you. Respected Mr. Dinesh Khara, Mr. Ashish Kumar Chauhan, Dr. Mridul Saggar and Tirthankar Patnaik, my friends Anantha, Narayan, Samiran, Chetan, Rudrasen Sharma and his colleagues from IIM Kozhikode. I also see at a distance Mr. Ayyappan Nair from RBI, who prepares the excellent twice-a-year financial stability report. So in fact, ideally, he should be the one talking about this topic here instead of me. So before I share with you my remarks, I would like to solicit your sympathy for me. When Mridul Saggar wrote to me and said I should speak on macro financial stability and spillovers in an integrated world, he basically packed 4 topics into one headline. And now Tirthankar tells me I should conclude this talk within 20 minutes. When each one of them is fit for a day-long seminar. Macroeconomic stability, financial stability, spillover, and are we in an integrated world or not? So I'll try to do justice to it within the time allotted to me. Are we in an integrated world or are we becoming fragmented? You will be surprised to know or hear from me that I don't think we are becoming less integrated or more fragmented, much as commentary would like to have us believe that it is the opposite. In terms of global trade volumes, it is very difficult to disentangle the effects of economic slowdown and the fact that there could be trade restrictions, both of the tariff variety and non-tariff variety. And of course, countries are focusing on friendshoring, reshoring, all those things are definitely happening. So it is not that we are in the golden era of no need to plug in, no need. Era of globalization, but at the same time, based on the trade data, it is difficult to make out the case that we are definitely becoming more fragmented. Let me just share with you some numbers. The rapid growth of China's new breed of green exports actually went up by 30% year on year in 2023 to around $140 billion. And this is happening despite the Chinese economy undergoing a deep property slump, deflationary pressure, and low investor confidence. And if countries are trying to diversify away from China to other sources of supply, actually it ends up simply being a rerouting of China's products through these markets. And Vietnam appears to be playing that role. For example, Vietnam exports to the US and imports from China have surged since US-China trade tensions emerged in 2018. Annualized exports to the US from Vietnam rose from $42 billion in 2017 to around $113 billion in 2022. And in October 23, it was about $95 billion. At the same time, Vietnam's imports from China went up from $59 billion in 2017 to $121 billion in 2022, and then slightly moderating to 108. So as you can see here, Vietnam's exports to America surged, and Vietnam's imports from China surged as well at the same time. And you look at the data for Thailand, Mexico, etc., the same story emerges. And let me also tell you how difficult it will be for nations to diversify or reinsure their supply chains. If you look at China's involvement in global trade, you realize that in 2019, China exported 87 out of 87 HS2 products. 1,133 out of 1,133 HS4 products. 4,396 out of 4,422 HS6 code products. So you can imagine their footprints in so many product areas, and China's export market consists of 209 out of 225 countries, and it is the largest exporter to 74 countries in the world. These are all data as of 2019, pre-COVID. So when we talk of de-risking from China's supply chain, we should be under no illusion that it is something that can be achieved at the speed with which you can put out a tweet. Okay? It is going to take much longer. You move away from trade and look at renewable energy and dependence on critical minerals and rare earths. The production of these rare earths and critical minerals is concentrated in a few countries, but the processing of them happens exclusively in one country. If you haven't yet picked up a copy of Ed Conway's Material World, you are missing something. That's a book that was a runner-up last year or the year before in the FT Schroeder Business Books of the Year Award. The world will be using more copper between now and 2050 than it has used since the metal was discovered. And you look at lithium, you look at nickel. You may say Indonesia exports nickel, but most of those Indonesian nickel mines are owned by Chinese companies. The same thing in Congo, same thing in Argentina and Chile, etc. So, are we really de-risking? Are we moving from an integrated to a more fragmented world, or are we becoming embroiled or entrenched in a more concentrated world when it comes to trade or even renewable energy? In fact, I would even argue that the shift from fossil fuels to renewable energy takes the world away from de-risking towards re-risking, because you are going to depend on one single source for many of these critical minerals and rare earths. So therefore, in that sense, if we interpret macroeconomic stability in a broader sense, we probably are creating the conditions for more instability rather than less. But if you interpret macroeconomic stability very narrowly, in terms of fiscal and monetary stability, you may argue that countries do have some autonomy. But if you expand it to include many aspects of real economy, I'm not so sure that we are becoming less integrated or even less riskier, much as we like to use the phrase de-risking. Of course, when it comes to macroeconomic stability, the fact that countries have their own policy levers to pull is very exemplified by India's own macro stability in the last several years during COVID and afterwards. One of the reasons why we have been able to grow at 7% plus in the last 3 years, and if RBI is correct, it could be a fourth year in a row in FY25, is partly because we did not overstimulate the economy during COVID, both of the fiscal and monetary variety, and whatever stimulus we gave was calibrated and targeted. And more importantly, both fiscal and monetary policy began to pull back from those levers in time. Unlike, let's say, 10 years ago, or for that matter, unlike what other countries are doing even now. I mean, look at several countries, the fiscal deficit ratio still is around 6 to 7% of GDP in some countries. So in that sense, Whether we look at growth or inflation or current account deficit and currency stability, we have demonstrated that despite the issues I highlighted in the earlier portions of my remarks, we do have certain room for practicing macroeconomic stability, preserving it and nurturing it, and reaping the benefits of it in terms of a better growth inflation dynamic as well as external stability. But when it comes to the world of finance, where I would actually posit, and this is an academic institution that is hosting this conference, and therefore one should set off a few fires here for discussion. When it comes to financial stability, I would argue that a slightly more fragmented world will be desirable. And that was the burden of my song in 2019 when I wrote the book, The Rise of Finance, Causes, Consequences, and Cure. But there is no sign that in the world of finance we are becoming less integrated either. Financial stability, you can think of it as stability broadly speaking, banking, non-banking, and capital markets. In theory, the first two are less susceptible to spillover effects, and the last one more so, capital markets. However, in practice, it turned out very different in the 2007-8 global financial crisis. In fact, Europe continues to suffer, even a decade after the global financial crisis, as employment output and wages have stagnated significantly. As recently as 2019, 18 advanced economies still showed negative deviations in output compared to pre-global financial crisis levels. In fact, one could say that Europe has never really returned to the pre-crisis economic dynamism or economic situation. And even India, which was considered somewhat more distinct or less integrated, our domestic banking was not immune or exempt from global spillovers. The capital flows in 2004 to 8 period led to a domestic credit boom. Just to look at the banking assets to GDP ratio, which were hovering in the 20 to 30s between 1980 and 1990, surged to 55-56% of GDP in one decade. It is a ratio, by the way. It is not absolute numbers, doubling in one decade. So you can imagine the domestic credit boom that happened. Regulatory forbearance as a precautionary measure resulted in unintended consequences. And then banks and firms engaged in evergreening of loans. All of these things actually ended up in a situation of non-performing assets, which were around 2% in 2008, went going over to 10% in 2018, with some banks even having a ratio of more than 20% of non-performing assets. So we were not exempt from a global financial crisis, which many people still call a North American or an Atlantic crisis. It was not. It was really a global financial crisis. And the 2004-8 capital flows also led to emerging economies experiencing currency appreciation, which resumed in 2009 and up to 2011 as well. Brazilian central bank governor at the time, Arminio Fraga, called it actually an act of war. The low interest rate policy of the developed world, sending capital out in search of yield, well known in the industry as carry trade, created basically a boom-bust cycle for exchange rates. You just have to do a simple internet search for the currencies that appreciated so much between 2004-8 and 2009-11. They actually tumbled a lot in 2012-13. Exact polar opposite of what happened in those 7 years compared to what happened in the next 2 years, and Indian rupee was one of them as well. Why is that? Why is this kind of spillover still there? Because in truth, even now, when it comes to financial markets, there is one country, one economy, one market, one monetary policy, and one currency, which is the United States and the US dollar, Federal Reserve. They matter. This is true even after the advent of China as a very large economy. The reason is American consumer still happens to be the first and the last resort for many countries, whether you are directly exporting to America or indirectly through other countries. So therefore, the global demand, if anything, in spite of the low growth post-COVID, the world hasn't really tumbled into a recession. It is because of the resilience of the American consumer even now. So in that sense, the financial world is not just integrated, it just depends on one country and its monetary policy trajectory and therefore its currency movement impacting other countries. Therefore, I would like to see more fragmentation. But it is not yet a reality. The euro, more than 20 years since its inception, hasn't lived up to its promise of providing us an alternative to the US dollar. And China's economy is battling its own macroeconomic challenges. In any case, as long as one has a closed political system and capital controls, it's very difficult to become a global reserve currency and a global store of value. Okay? So, today, even if countries have no de jure fixed exchange rates, they still have de facto fixed exchange rates with the US dollar. That is why monetary policy cycles are synchronized. You ease when the US eases and you tighten when the US tightens. It is not just because of trade flows and trade competitiveness, it's also because capital flows, because when US interest rates are extremely low, other countries tend to attract so much of capital flows that they want to make themselves less attractive if possible, and therefore they lower interest rates. And then when the US starts to tighten, there's a scramble to repay and a hunt for dollars, and therefore you are forced to tighten monetary policy to attract the dollars that you need to be able to repay those loans. So you can imagine you are in a de facto fixed exchange rate regime, and both spillovers and integration are unfortunately still a fact of life. And the fact that we are dealing with the global debt crisis today, low-income countries, is because of the policy of extremely low interest rates, ultra-accommodative or unconventional monetary policies that US and developed countries followed in the second decade of the millennium. In fact, it is wrongly argued that developing countries' debt crisis today is because of higher interest rates of 2022 and 2023. That's not true. The debt crisis that low-income countries are facing today is because of the low interest rates that prevailed for much longer earlier in the previous decade. Is there a way out of this? So far, it doesn't seem to be the case. Therefore, developing countries are in a situation of heads you win, tails I lose situation. So there is even less macro stability and even less macro autonomy in a financially integrated world. And financial fragmentation has not really commenced at all. Therefore, in theory, there is sovereign policy autonomy. Then, if advanced countries are, as one would expect, setting monetary policies for their domestic economic agenda, as they are entitled to, the question that arises is, should emerging market and developing economies do so as well? Do they or can they? The answer is no, because the interest of global financial institutions and their clients accentuate the spillovers and lack of policy autonomy for emerging and developing economies, and therefore still endanger macro and financial stability in these economies. That is a question we need to ponder. In order to maintain macro and financial stability, do capital controls in some fashion or the other, selectively or otherwise, should it need to come back into policy vocabulary and discourse and discussions, let alone policy formulation? What are the various tools to enhance your policy autonomy? And capital controls is a legitimate such instrument of policy autonomy. And then next is the role that credit rating agencies play in encouraging spillovers, because their ratings transmit from one country to the other, creating contagion effects. Financial institutions and financial market players wake up when one country is downgraded, which usually happens after the fact, that after their fundamentals have already deteriorated, when it is a time for contrarians to start buying, the credit rating agencies will actually be downgrading them. That's a different story. But when they do so, other countries also catch the cold. And therefore, they also play a part in spreading spillovers. What do we do about them? There are no easy answers. And lastly, I would like to leave you with the question. When we are so keen to welcome multipolarity in the world, in terms of intellectual integration, we are homogeneous and not heterogeneous, because most of us end up going to one or two Western nations for our higher education and come back. Are we learning multiple schools of economics? Are we understanding that there are different policy options except one particular neoliberal agenda? So how intellectually fragmented we are, and that is a world where I would actually argue and make a case for more intellectual diversification and less intellectual integration. That is where everything starts. So if you want to have a less integrated, or in other words, more diversified world of macroeconomy and finance, we actually should become less intellectually integrated and more open and more pluralistic. As long as that is not the case, the rest of the diversification or less integration will not happen. Spillovers will remain a challenge, and macroeconomic and financial stability will be elusive except for a very few countries. Thank you very much.
Thank you, sir, for a very interesting and insightful talk. We would now have a Q&A. There's a QR code on the screen. You can scan it and post your questions.
From the floor, they can just ask.
Yeah.
What's the collateral damage for China's attack on US dollar hedging? Maybe I should ask you the mic. Good morning. I'm Royston from Grameen Bank. Question is, what is the impact, that's collateral damage that's going to happen because of China's war on US dollar hegemony?
Yeah. But has China been able to mount an effective challenge to the dollar at all in the first place?
We're seeing a lot in Africa. I mean, I think in the developing countries, global south, there seems to be some real momentum, and that could be disruptive for the next couple of decades. So in terms of the development agenda, at least, are we seeing a lot more collateral damage than we are ready to accept?
No, that's No, that's a good question. But ultimately, in terms of the magnitude that are still happening, while it may be true that in some parts of the world, Chinese yuan, because of their swap arrangements or because of OBOR and other forms of bilateral assistance or lending arrangements, one might get the impression that the yuan is making much inroads. But I think, if I'm not mistaken, Professor Ishwar Prasad has been writing with a lot of data showing that they have barely made a dent in the ubiquity and pervasiveness of the use of US dollar for both the bilateral lending transactions or capital market transaction, or as unit of account and settlement currency in both trade and capital markets. So I'm not sure that while I acknowledge your point that in some countries it is, China is trying to grab market share, if I may say so, I don't think it is meaningful enough in terms of volume for us to think of it as a sort of posing a formidable challenge yet to dollar's hegemony. If anything, I think what I might say so is you look at the fiscal policy in the United States, where post-COVID the fiscal deficits are still very high, etc., and debt burdens being on the higher side, not just the US, everywhere. So it will be more domestic economic fundamentals that would have a much larger bearing on what happens to the US dollar rather than competition from other countries. Thank you.
Globally and India, this climate risk, are we factoring in the monetary policy as well as in the financial, planning in terms of the budget and other things? Because that is going to affect food security and of course, in all respect of human, our sustainable development goals also. I wanted that matter to be little elaborated.
No, whether monetary policy is factoring in climate risk into its calculus or not is probably addressed to somebody from RBI. None of us are from the RBI. Mridul is...
Yeah, so actually there is some recent literature on how climate risk can matter for the basically monetary policy. I would urge you to go through the report on currency and finance which the Reserve Bank produced last time, and there is enormous material in that on how it matters for the monetary policy.
In some of the spillovers that are taking shape now. Do you think that rating agencies also need to review and relook the metric framework within which they...
Some of you might know that we did write about it in a collection December. I mean, the role that they played in the propagation of the crisis was very evident in 2000. Both in misvaluing them, the collateralized mortgages, and then later on in downgrading them in one swoop. So, but this, who gets to bell the cat and how and why and what is the incentive for anyone to change the existing status quo from their point of view? There isn't one. A new credit rating agency, a new kid on the block, how do you then deal with the oligopoly of the existing institutions? And so I'm not sure there are easy answers to break this spell of the dominance that they have, unless regulators in the developed world themselves bring about these change and introduce more competition legitimately. Otherwise, it is very difficult to see the status quo changing within a short horizon, much as we might say that there is a need for change, which is well established, both in terms of the implications that they carry, the usefulness of the rating changes, whether they happen at the right time or much delayed manner, etc. But also in terms of the methodologies, and we wrote about it, about the non-transparency of some of the criteria they follow and the arbitrary selection of both the so-called expert opinions that go into the qualitative ratings. All these parameters, all these things are definitely crying out for overhaul, or at least an open discussion. But we are still struggling to figure out how to initiate that and how to make it happen.
This is Anupam Johari from Raiffeisen Bank. I had a question. What are the monetary and fiscal conditions that India needs to reach for the Indian rupee INR to become fully convertible?
So I think convertibility on the capital account is a journey we have already begun. There is no timeline for that, but you asked for basically not the timeline and probably basically like what metrics would enable us. So kind of convertibility will be more than just macro stability parameters, but it's essential to bring down the fiscal deficit further from here, and for interest rates to be aligned globally, inflation to be aligned globally, because you can't have an inflation differential running. See, it's an extraordinary situation where advanced economies have higher inflation rate than ours in recent period, but that's not going to stay. But endemically, we are a higher inflation economy. I think this budget has made a tremendous progress in consolidation. And while I was critical of the last budget for not enough fiscal consolidation, I this time wrote and gave it full marks for basically trying to achieve goalposts which are extremely difficult, and the consolidation trend has established our credibility, which in due course might affect rating, as somebody sort of said. So I'm very positive about it. So that journey will take a little longer. So let's live with it. Another point which Dr. Nageswaran was very emphatically pointing out was about the Chinese yuan and its convertibility and sort of SDR basket. It only meets technically one of the two criteria. It's trade, essentially it's the trade size, but for financial transaction it's still not acceptable. So these things are very difficult. It's a long journey in the process.
Good morning. Thanks for the insightful thoughts from the eminent panelists. To introduce myself, Pawan Goyal, I'm junior of Anantha from IIM Lucknow and ex-JPM banker. Currently doing my PhD. My question to the point that Khara sir mentioned about the climate risk. So wanted to ask, when we are talking about climate risk, first the accounting standard and second the ESG standards, how they are evolving to assess it. And second, when do we think in the future the banks will be able to bring the climate risk into the risk model and into the pricing?
In fact, as a lending institution, we have already started evaluating our borrowers on the ESG rating. Though, of course, it is not influencing our decision in terms of the interest rate for the borrowers, but nevertheless, we are also sharing those ESG rating with the borrowers just to make them aware where do they stand. I think these are the early days. Our ask was to the regulator, if at all, there could be a nudge from the regulator in terms of helping the banking system in differentiating on the pricing parameters. But as of now, it has not happened. If you really ask me, there are two, we had put across two asks. One, of course, reduction in the CRR for the green deposits. And also the second one was that if at all, as a policy, it can be incorporated. The early beginning has happened from the regulator side also, but I think maybe it is another 2 to 3 years when perhaps it will start having an impact on the pricing too. But nevertheless, what I would also like to mention is that we are required to report the scope 3 in the being the listed entity to SEBI. So I think there's a increasing awareness being created in the ecosystem, which will eventually start impacting on the pricing part also. So I think we're in the right direction. The second question which you had put across relating to the accounting system for the green, to my mind, there has to be some kind of accounting standards, which perhaps can be given by some of the accounting bodies like ICAI type of bodies, or who can actually define these accounting standards. So unless and until the green component is captured across the organization, and also then there would be a need for its auditing too. Because if at all there is a green source of funding, then naturally all those who are providing the green funding, they would like to have some kind of a credible numbers too. And for that, perhaps even auditing will also emerge. That's how I look at it. And we are engaging with some of these entities also to see that if at all there can be some accounting standards which can be laid out. Thank you.
Thank you.
So there's a question on the portal. What are your thoughts on India emerging as the world's factory?
This can be the last one.
Yes. Yes.
No, I think there is enormous potential for that to happen. And some of the preconditions have been laid, because one of the reasons why we didn't industrialize enough was the absence of commensurate physical infrastructure, which has made tremendous progress in the last decade or so. And therefore, and given the interest that the rest of the world has in creating alternatives to the existing source of supply, the journey has just begun, and the potential is quite huge. And therefore, whether India emerges as the world's factory on the scale of China, that is probably not a relevant metric to compare, because countries and the context differs from what it was between 1980 and 2015 or so. But definitely India can emerge as a very important player in the global supply chain. Whether it is whether we will exactly emulate China or not actually is not necessarily an important way to look at this issue.
Thank you. So this brings us to the end of the inaugural session. May I invite Professor Thomas to deliver the vote of thanks?
A very warm good morning to all of you, dignitaries on the dais, Dr. Anantha Nageswaran, Chief Economic Advisor, Government of India, Mr. Ashish Chauhan, MD and CEO of NSE, Guest of Honor, Mr. Dinesh Khara, Chairman SBI, Professor Mridul Saggar, Head Uruppika, Mr. Tirthankar Patnaik, Chief Economics NSE, faculties, center, friends, ladies and gentlemen, students, everyone. It's a great pleasure to propose the vote of thanks at the first IMK conference organized by Uruppika, Center for Excellence in Macroeconomics, Banking and Finance, supported by the National Stock Exchange. We, the Uruppika team, is delighted to have created a platform to discuss, dissect and disseminate on the theme securing financial stability amid global spillovers. We have in our midst 200 odd delegates, speakers, drawn from the various walks of life. On behalf of Uruppika, IMK, let me first thank each one of you. First, let me thank Dr. Anantha Nageswaran, Chief Economics Advisor, for accepting our invitation to be present here. Thank you for the thoughtful inaugural address that has set the tone of our conference. On behalf of IMK and the Center, we thank you, sir. Mr. Dinesh Khara, Chairman SBI, for associating with the conference. Thank you for delivering the comments and accepting our request to be the guest of honor of the session. Thank you, sir. The conference is largely possible due to the unflinching support from the NSE. In this regard, we are grateful to Mr. Ashish Chauhan, MD, CEO of NSE. On behalf of the Center, we thank you, and we hope that you would continue associating and supporting our activities and future economic endeavors. It would be unfair if I don't thank Professor Mridul Saggar, Professor of Practice and Head of the Center. You've designed the conference, and your painstaking efforts are very visible, and we thank you, sir. I have to thank the NSE staff and who have coordinated with the Center. Mr. Patnaik, on behalf of IMK Center, we truly acknowledge your service. A big thank you to all of you. No conference is elegant without an elegant audience. We are thankful for each one of you who are present here, students, faculty, Center members, a big thank you. Ladies and gentlemen, once again, I want to state that we are most grateful for all of you. We thank you for being with us in this morning. It's a great pleasure. Thank you once again.
Spice the